On the morning of September 15th, 2008, employees of one of the oldest and most powerful investment banks in the world arrived at their offices in Midtown Manhattan carrying boxes because the night before, the bank they worked for had filed for bankruptcy and their careers had ended without any real warning at all. Lehman Brothers was 158 years old. It had survived the Civil War, both World Wars, the Great Depression, and dozens of financial crises across a century and a half of American history. And in the space of a single weekend, it was gone. That Monday morning, September 15th, 2008, became the single most consequential day in the global financial system since the Great Depression, and the ripple effects of what happened in those hours reshaped the world economy, cost millions of people their jobs and their homes, and forced governments everywhere to ask a question they had been avoiding for decades. What do you do when a bank is so large and so connected that letting it fail threatens to take everything else down with it? Before we can understand what happened to Lehman Brothers, I want to tell you where the phrase "too big to fail" actually comes from, because most people assume it was invented in 2008, but the real origin is a quarter century earlier, and it tells you a great deal about how long this problem had been building inside the American financial system. In 1984, a Chicago bank called Continental, Illinois, at the time the seventh largest bank in the United States, found itself in serious trouble after a series of bad loans collapsed, and depositors began pulling their money out in what became the largest bank run in American history up to that point. The federal government stepped in with an enormous rescue package, protecting not just regular depositors, but also large institutional investors who would normally have been expected to absorb losses on their own. And when a congressman asked regulators why they had rescued those large investors, the response was blunt and historically significant. Continental Illinois was simply too big to fail. That phrase entered the financial vocabulary in 1984, and what it described was a genuine dilemma that governments and regulators have never fully solved. When a financial institution becomes large and interconnected enough, allowing it to fail can trigger a chain reaction through the entire financial system that causes far more damage than the cost of a rescue would have, which creates a powerful and dangerous incentive for banks to grow as large as possible. Lehman Brothers in the early 2000s was not a traditional bank in the way most people picture a bank. It was an investment bank, meaning it did not take ordinary deposits from everyday customers, but instead operated in the much larger and much more complicated world of securities, trading, and financial instruments that most ordinary people will never encounter directly, but that underpin enormous amounts of the global economy. In the years leading up to 2008, Lehman had made an enormous bet on the American housing market, buying and holding huge quantities of mortgage-backed securities, financial instruments that were built from packages of individual home loans bundled together and sold to investors as if they were reliable, high-quality assets. The problem, and this is the heart of the entire 2008 financial crisis, not just the Lehman story, was that a very large number of those mortgages had been made to people who could not realistically afford to repay them, in a lending environment where standards had been abandoned almost entirely in the rush to generate fees and volume during the long housing boom of the early 2000s. Lehman had borrowed enormous amounts of money to amplify its bets on the housing market, operating at what financial experts call high leverage, meaning for every dollar of its own money it had invested, it had borrowed roughly $30 more, which meant that even a small decline in the value of its assets could wipe out all of its own equity and leave it unable to repay what it owed to the people it had borrowed from. By the summer of 2008, it was becoming increasingly clear to the people inside the financial system, though not yet to most of the public, that Lehman was in serious trouble and that something needed to happen before the situation became uncontrollable. And so, in the second week of September 2008, Treasury Secretary Hank Paulson convened a series of emergency meetings that would determine the fate of one of the most powerful financial institutions in the world. The government's decision not to rescue Lehman was not made carelessly or without awareness of the potential consequences. Paulson, Federal Reserve Chairman Ben Bernanke, and New York Fed President Tim Geithner all understood they were making a historic and potentially catastrophic choice. But they were constrained by legal limits on what the Fed could do without a buyer willing to absorb the losses, and ultimately, no buyer emerged on the terms that would have made a rescue possible. The specific sequence of events that led to the collapse has been debated by economists and historians ever since. Was the decision not to rescue Lehman a policy choice or a legal constraint? Was it a deliberate signal to markets that risk had consequences, or a terrible miscalculation of how interconnected everything had become? And there is still no complete consensus on what the right decision would have been, even with perfect hindsight. When global financial markets opened on Monday, September 15th, the reaction was immediate and severe in ways that confirmed the fears of those who had argued Lehman was too interconnected to be allowed to fail without triggering a broader catastrophe that would spread far beyond the walls of one investment bank. Within days of the Lehman collapse, a money market fund called the Reserve Primary Fund, which was supposed to be one of the safest possible places to hold cash, functionally equivalent to a bank account for many institutional investors, announced that it had broken the buck, meaning its value had fallen below $1 per share because of losses on Lehman debt it had been holding. That announcement caused a run on money market funds across the entire financial system, as investors who had assumed their cash was safely parked in these ultra-conservative vehicles suddenly scrambled to pull their money out, triggering a credit freeze that threatened to shut down the basic day-to-day borrowing that even healthy companies relied on to make payroll and keep their operations running. The government moved with extraordinary speed in the days after the Lehman collapse to prevent the entire financial system from seizing up completely, guaranteeing money market funds, backstopping the commercial paper market, rescuing the insurance giant AIG at a cost of over $80 billion, and ultimately pushing through the $700 billion TARP bank rescue program that remains one of the most controversial and consequential financial interventions in American history. I want to stop here and talk about something that often gets lost in the financial detail of the 2008 story. Because when we focus entirely on the mechanics of mortgage-backed securities and leverage ratios and credit default swaps, it becomes easy to forget that the consequences of what happened in those September days fell most heavily not on the bankers in those emergency meetings, but on millions of ordinary Americans who had nothing to do with any of the decisions that created the crisis. Between 2008 and 2010, approximately 8 million Americans lost their jobs as the credit freeze triggered by the financial collapse spread into the real economy, and businesses that could no longer borrow money began cutting workers in order to survive a demand collapse that nobody had predicted would be quite so severe or quite so fast. Approximately 4 million American families lost their homes to foreclosure during the same period, many of them people who had taken out mortgages during the housing boom that they genuinely believed they could afford and that lenders had told them were safe, only to find themselves underwater on homes worth far less than they owed, at the same moment that the broader economy was eliminating the jobs they needed to keep making payments. And the recovery from those losses was slow and deeply uneven. American bank stocks recovered relatively quickly once the government interventions stabilized the financial system, but median household wealth, employment rates for working-class Americans, and homeownership rates in communities hit hardest by the foreclosure crisis took many years to return to anywhere near pre-crisis levels, and in some places never fully did. The aftermath of the 2008 financial crisis produced the most sweeping overhaul of American financial regulation since the Great Depression. The Dodd-Frank Act, passed in 2010, created new oversight bodies, imposed stricter capital requirements on large banks, established mechanisms for resolving failing financial institutions without taxpayer bailouts, and attempted to address many of the specific vulnerabilities that had allowed the crisis to develop as catastrophically as it did. But here is the thing that I think is the most honest and the most uncomfortable part of the whole story. The banks that were considered too big to fail in 2008 are in most cases significantly larger today than they were then, because the consolidation that happened during and after the crisis as weaker institutions were absorbed by stronger ones left the American banking system more concentrated rather than less concentrated than it was before the collapse. The fundamental tension that created the too-big-to-fail problem has not been resolved. We have built better guardrails, better resolution mechanisms, and higher capital buffers. And those things genuinely matter and genuinely make the system safer than it was in 2008. But the underlying question of what happens if a large interconnected financial institution fails in conditions that overwhelm those safeguards remains as real today as it was when Continental Illinois first forced it into public conversation in 1984. Lehman Brothers was 158 years old when it filed for bankruptcy on September 15, 2008, and its collapse in a single weekend triggered the worst global financial crisis since the Great Depression, wiping out trillions of dollars in wealth, costing millions of people their jobs and their homes, and forcing governments around the world into emergency interventions on a scale that none of them had ever contemplated before that morning.